Good morning. We are half an hour from the open in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Rebecca Choong Wilkins.
Our top stories this morning. Asian stocks and bond yields decline as Trump's tariffs hit risk sentiment. China is vowing necessary measures to defend its interests as the U.S. doubles levies to 20% while telling Canada and Mexico there's no room left for negotiation.
Now, Trump also pausing all military aid to Ukraine, turning up really the heat on Vladimir Zelenskiy days after their clash at the White House.
Also ahead, BYD raises more than $5 billion in Hong Kong's biggest share sale in nearly 4 years.
And I'm Stephen Engel in Beijing, where China's top leadership is set to begin key political meetings today to sort of map out the latest priorities, economic revival plans, seeking, of course, to counter Trump's trade war.
Good morning. Welcome to the show. To say that there is lots to unpack is an understatement. When you look at these markets, though, it doesn't seem, and the other point we want to make too is it doesn't seem we are overly concerned when you look at price action today, although that could change, obviously. Now, all that being said, there's a lot of news flow coming through, which we'll get to in a moment with our team just about across the world. The story across markets, I'll just make this very, very simple. Stocks are slightly lower, 0.3%, although that is, I guess, in some ways being offset by some of the moves in Korea, which is that market, of course, that is reopening today. The markets that are, I guess, fairly representative of risk appetite, particularly when you look at things like tech, AI, semiconductors. So you have Taiwan, for example, 1.6% to the downside. That's coming online right now. U.S. 10-year yield continuing to see some downside right now. We're down 2.5 right now on the 10-year, which effectively puts the 4.13 handle, the lowest here in several weeks. Brent crude is another thing to talk to, another indicator, I guess, of the risk and the growth outlook ahead, falling to the lowest level so far of the year, and more downside, as you can see, of course, as we go into today. Right. Very quickly, let's flip the page, please, and have a look at how we did as far as U.S. listed Chinese equities. BYD, of course, is a stock we'll be focusing on today, going into the open today. The biggest cash call in nearly 4 years in Hong Kong at a 7% discount to the close. So do expect some pressure there. Alibaba and Kingsoft Cloud among the biggest decliners overnight. Now, that takes us into futures right now, 27 minutes to the open, and we're looking at contracts in Hong Kong and in Singapore. Some modest downside. That's about 0.4 and 1%. We have just come off a little bit, the 730 handle on dollar China. And of course, we talk about Brent crude and U.S. crude. Shanghai crude is playing some catch down there, 2.4% to the downside.
Yeah, I mean, tariffs, of course, mean that currencies are very much in focus today. It is basically tariff day here for both China, Mexico, Canada. China now calling on the U.S. to withdraw tariffs after President Trump ordered raising duties to 20%. Those take effect later today, together with a 25% levy on imports from Canada and Mexico. He spoke about the tariffs earlier.
On the tariffs, is there any room left for Canada and Mexico to make a deal before midnight? And should we expect those Chinese tariffs, the extra 10%, to take effect tomorrow?
No room left for Mexico or for Canada. No, the tariffs, they're all set. They go into effect tomorrow. China also had an additional 10, so it's 10 plus 10.
All right, let's get you all the angles to this tariff story. Let's bring in our team from across the world. Our chief North Asia correspondent, Stephen Engel, is outside the Forbidden City in Beijing. We're also joined out of Toronto in Canada by Derek DeCluet and Maya Averbach, of course, out of Mexico, really just on all the tariff front. And there's, individual responses we've heard so far where that applies. Steve, let's start with you. I'm looking at my Bloomberg screens right now. The Ministry of Commerce has just come out with a statement and a response here to those tariffs. Take us through what you know.
Yeah, that's right. We've been running through some of those headlines, and just the three that really stand out to me is that they, of course, the Ministry of Commerce here in China out right off the bat at the beginning of the day at 9 o'clock in the morning with this statement opposing the action that was signed by Donald Trump, obviously, just a few hours ago, adding another 10% tariff on top of the previously announced 10% tariff, so 20% total, as the President Trump just announced. And MOFCOM saying they strongly oppose that tariff tariff action and that these actions would not solve America's problems, vowing necessary steps to defend their own interests. China will do that, and also vowing some countermeasures. It did not outline what those countermeasures might be, but again, we did have a Global Times article yesterday quoting anonymous sources within the Chinese Communist Party, essentially saying that they could essentially start using tariffs of their own on agricultural imports from the United States, like soybeans, like they did in the first Trump trade war in his first term. Of course, China also imports a lot of corn and a lot of wheat, so you could likely be seeing some tariff action on agricultural products to China. 3-4 weeks ago, China responded to that initial salvo by attaching tariffs on about 80 different American products, but not as critical or not the large volume products. Essentially some tariffs on tractors and agricultural machinery. They also did some export controls on lithium minerals. So again, there were muted response early on 3-4 weeks ago. This time it could be a little bit more severe.
Bloomberg's chief North Asia correspondent Stephen Engel in Beijing there for us. Let's bring in Derek now in Toronto. I mean, tell us what we're seeing in terms of the Canadian response here.
Yeah, the Canadian response, the government is saying they're ready to go with their counter tariffs on U.S. products. Canada buys more from the U.S. than any other country. It was about $350 billion worth of goods last year. And so the initial response is similar to what Justin Trudeau unveiled about a month ago, which is a first list of tariffs on about $30 billion worth of goods. There's a lot of U.S. foodstuffs in that, things like coffee and wine. And then there's a much bigger list that includes big ticket items like cars and trucks, steel and aluminum, and that would come in a few weeks. That's worth about 125 billion Canadian dollars worth of U.S. exports. And that's sort of where we are. Now, Canada also has provinces with premiers who would also like to retaliate. So we heard from Ontario's premier, the largest province, earlier today, saying, well, why don't we just cut off the nickel exports from Canada to the U.S. That will hurt U.S. manufacturing. So a whole lot of ideas are being talked about up here.
Okay, Bloomberg's Derek DeCluet there in Toronto for us. Let's go to Mexico City now with Maya. Maya, tell us how the Mexican government is responding.
Well, Mexico has taken a wait-and-see approach. President Claudia Sheinbaum hasn't ruled out retaliatory tariffs, but up until now, her approach has been to try to reach agreements. We saw top cabinet officials from Mexico fly to Washington and have meetings on Thursday and Friday covering issues of trade and security. We also saw Mexico send people who were accused of high-level crimes, including drug trafficking and murder, 29 of them to the U.S. In an effort to appease the Trump administration and a change in tone of Mexico towards China. So Mexico is taking all of these steps to try to show the Trump administration it can be a partner instead of taking a retaliatory approach from the get-go. President Claudia Sheinbaum is in her first year in government, so this is a big deal for her.
Thank you so much, Maya. All across that story for us, that's Bloomberg's Maya Averbach in Mexico City. Now, sticking with geopolitics, a senior U.S. defense official has told Bloomberg that President Trump has ordered a pause to all military aid to Ukraine. This comes just days after President Trump clashed with his Ukrainian counterpart in the Oval Office. News desk editor Jill Deasist has more on this Bloomberg scoop. Jill, I mean, this story is moving so quickly. Tell us what we know so far about what this halt might mean.
Yes, so ultimately this would affect pretty much any military aid that is not already currently in Ukraine. So that does include any weapons that are currently in transit via Poland, for example. So we're talking about potentially a very sizable amount of aid here that's impacted by this new order that's just that we just reported on. It really does seem at this point, Rebecca, like we're talking about a pretty significant ratcheting up of this pressure campaign that Trump and his administration are really putting on Zelenskiy to kind of cooperate with some kind of deal here. Obviously, we all saw what happened in the Oval Office last week. We know that, Zelenskiy, obviously went to the UK as part of this emergency summit with other European officials trying to see how they could ultimately broker something. Now it seems like Trump is kind of coming in here, trying to ratchet up that pressure. I will remind you that just earlier on Monday, Trump did open the door for some kind of a deal with Ukraine. He was talking about maybe reviving that minerals deal, for example, that was really scuttled at the end of last week. But it does seem like it's contingent on some more cooperation with Zelensky. Does that mean some kind of apology, maybe some groveling? We know how much Trump really likes, a lot of these, leaders to kind of come to him and kiss the ring. We'll have to see. But yes, again, really ratcheting up that pressure campaign there.
Yeah, well, that's certainly not what happened, the kiss the ring thing over the weekend. Jill, thank you so much. Jill Dees is there, our news desk editor. Now, with these trade tensions intensifying, yeah, there's a lot to talk about, and we have you guys covered across assets. We're also talking economics. So JPMorgan Asset Management and UBP join us to talk equities and fixed income, respectively. And also looking ahead with what policymakers in Beijing might tell these markets these next day or two. With the two sessions, of course, up and running. Morgan Stanley and Natixis also joining us on shows today. Cutting down to the open of trade in Shanghai, in Shenzhen, and here in Hong Kong, this is the China Show. Okay, so just over 15 minutes away from the opening bell, and it's looking like this downside momentum has picked up in the last few minutes or so. As you can see, we're now down 0.5% on the A50 contract. Asia Pacific's down 0.4, and expect that to take a larger step lower when Hong Kong markets open up. Of course, the big stock to watch today is BYD. We are indicated, unsurprisingly, down about 7-8%, given that was the discount of this cash call, nearly the biggest one, and of course, in Hong Kong in nearly 4 years, Rebecca. Yeah,
that's right. So BYD, one of the names that we'll certainly be watching today. Of course, it fell about 9% overnight in the US. But really, for us, there's two big stories today. The first, of course, US tariffs. They are coming into effect 1 p.m. for China in Hong Kong, that is. And, of course, the CPPC begins today. We also have the MPC briefing. So really, Wednesday, in fact, actually tomorrow is the big day when we'll see Li Tian give that work report. We'll see the figure for GDP, for instance. Anyway, keeping an eye out on those two really big stories that are sort of dominating the news flow today, Dave.
Yeah, and really, when you look at how markets have navigated, I'm struggling for the right adjective, because it depends where you look in the world, right? U.S. equities have largely hit their heads in the ceiling, a couple of bear markets in the region. I think you have Indonesia and Thailand, 20% down. We're down 15% in India. But when you look at China, for example, largely unscathed, but obviously some losses right now.
There's an argument to be made that, in fact, President Trump has done China a favor by coming out with this 60% tariff. So, for example, even if we look at the implied vol on the yuan, a little bit today, but actually basically looks like longer term, 20% is already priced in.
Absolutely. And what do we do that with all that information right now? If you're sitting on an equity portfolio, let's bring in Julie Ho, Asia ex-Japan equities PM at JPMorgan Asset Management. How are you guys thinking about tariffs, and what does it mean for the near-term outlook here for equity markets?
Good morning. Well, invested in Asia, tariffs is inevitable. This is a region that is very export-oriented, but it's something that we've had to deal with through the noise and through the developments. So I'd say it really comes down to the bottoms-up stock picking. understanding which are the companies that are really the enablers that are irreplaceable, because with that comes the moats and the pricing power. And the good thing here is we've been through this before. We have precedents of what's happened in prior tariff situations. We look for those companies that have been able to work with their customers, their partners, to share that burden and showing that the moats are coming through, as well as companies that have over the years really widened their manufacturing footprint, bringing more of the manufacturing hubs into the U.S. So it's something that we've been dealing through the years, and it's nothing that's new. But I would say from a portfolio construction level, it's very important to embrace that diversity of stocks. So yes, they're the exporters, but we also have the domestic consumers. We also have the financial system that is very much grounded in the economics of the region rather than being swung by exports.
So talking about some of those buffers, I suppose, to tariffs, thinking about domestic consumption, thinking about the financials, where are your top convictions lying?
So actually, back to David, your comments, we've seen some pretty big action out of India, Indonesia. And so where our top conviction is really in the banks. And so when we talk about the emerging market Asia names, some of these Indonesian banks or Indian banks, we do think valuations have gotten to a very attractive or reasonable level. So that's one. And when we talk about the portfolio buffers, the defensives are always the bread and butter of our income fund. And historically, we've had a lot of our defensives in Australian staples, Australian telcos, and now we're finding some opportunities in, say, Indian REITs or even some of the Chinese utility names. So it's really spread across the region.
Is that just another way of saying be defensive and focus on, let's say, income strategies in an equity portfolio at this point?
Defense and offense is what we always talk about. So you've got your defensives. We tend to be overweight defensives.
Okay, what's offense then?
Offense would be technology. Offense would be cyclicals or some of the higher growing Chinese names that happen to also be income names because of the better shareholder return policies that we've seen.
Okay, let's talk about tech. I mean, we have to talk about tech.
Yeah.
The rally, can it be sustained, and how reliant is this on stimulus? What stimulus do we need to see coming from Beijing to sustain that rally?
And I think what you're talking about is really the Chinese tech space. And so what we've seen in the China rally has been an incredibly narrow rally. And so what we'd like to see is a broadening out of that rally. And for that to happen, we really need to see the broad consumption come through, broad housing stabilizing, which we're starting to see glimmers of in Tier 1 and some Tier 2 cities. We're actually starting to see better pricing data come out, better transaction data coming out. So I think you could say that we are bottoming out here, and the next would come from the consumers feeling more confident. And certainly with the action we've seen year to date, the consumer should hopefully start feeling a bit more of the animal spirits coming through.
Have you seen anything actionable, though, to broaden out your own portfolio beyond the usual big tech names, Tencent, TSMC? I know you can't talk specific names, but to just build on that point you just made there.
And so one thing we've been doing in our China portfolios, there are certain sectors that tend to be very income heavy, right? The financials. And what we've done is start rotating some of those positions into some growthier areas. Outside of what you talked about, there's also the EV ecosystem names. They tend to be growthier, but like I said, with better shareholder return, they've also come into our income universe.
Does the NPC matter to you? Do you think investors are placing too much importance on it?
So we tend not to really make a directional, position based off what we think will happen. I think the outlook here is really it's going to be moderate fiscal stimulus, but what we're really looking for is that split of where does the fiscal stimulus go into, and what we'd like to see is it goes back to housing, goes back to consumer to really broaden out the recovery that we're seeing.
Where do you think we are in valuations in this Chinese market? How are you thinking about that? How are you thinking about the other metric, which is momentum as well, because we've seen a lot of money come through the Stock Connect.
So if you look at overall valuations at MSCI China, we're back at 1.5 times book. So it's not really, it's reasonable. It's not really attractive level. But what I just referenced is this rally's been very narrow. So underneath the hood, there are still many opportunities that are value income stocks that we think still have a chance to see the recovery come through in the fundamentals and the stock price.
I have a quick question for you. You mentioned price to book. Why do you guys use price to book?
Because we know economies tend to be cyclical, so price to book is just a more stable valuation. Yeah.
Okay. Julie, nice to see you.
Oh, thank you.
Julie Ho there, Asia ex-Japan Equities PM at JPMorgan. Asset management. Okay, a couple of stocks that we're tracking. Let's start things off with the obvious low-hanging fruits. 7.5%, 336 a pop, the biggest cash call in nearly 4 years here in Hong Kong out of BYD. So yeah, certainly the company's taking advantage of the massive pop in the stock price. Not just this year, right? If you measure that all the way back, this has really been one stock that has, I guess, in many ways proved, interestingly enough, counter-cyclical, which is really a cyclical stock. But yeah, lots to watch today.
Yeah, both the H shares and the A shares for BYD hitting their all-time highs this month. So yeah, in some ways unsurprising. There's plenty more ahead. Stay with us. Tariff day, MPC week rather. Yeah, this is the China show. You're watching Bloomberg. Good morning and welcome back. You're watching the China show. We're 6 minutes off the open in here, and just some breaking news crossing the desk. Seven and I first rejecting Couche-Tard's proposal. That's according to Yomiuri newspaper, Japanese newspaper. Yeah, stocks have fallen about 10% or so already.
Yeah. There we go. I mean, we'll keep on top of the story. Yesterday, in case you missed it, right, some of the reporting around this out of the Nikkei is that the CEO is stepping aside. Couche-Tard was said to be also preparing to establish an office in Tokyo in preparation for a potential bid, and now we know it's perhaps the opposite momentum to that story. Right, BYD, let's check out what that's doing. So right after, I believe, the Hong Kong close yesterday, news that the company was going to do a share sale, a massive one. We're talking over $5 billion US. We had a drop in 9% in the U.S. listing. We're down 7.5% right now, which is roughly in line, Rebecca, I believe, with the discount in terms of the pricing, the share sale against the last close here on BYD.
Yeah, that's right. I mean, the other story, or the other element, I suppose, of the BY story, in fact, is linked to the big tariff story that we're seeing today. You know, potentially this is part of the big global expansion plans that BYD has put forward. It's all about trying to localize, a sort of localization strategy, essentially to try and sidestep some of these China tariffs, setting up factories all over the world, not least Mexico.
Mexico, Eastern Europe as well, has come up really as in terms of just increasing that capacity there. Now, speaking of what the tariff story is doing as far as the global outlook is concerned, it's really led to, I think, the OPEC Plus story and what they're planning to do, maybe to shore up prices and what they're doing as far as matching supply and demand. So oil prices are effectively, and you look at Brent, you look at West Texas, you look at the Shanghai crude contract, now at the lowest level of the year. And as you can see, equities are reflecting that drop in global energy prices. Right. Now, as we go into the open today, we're down to 1.5%. Hang Seng Index, A50 futures are off 0.7 to 1%. Should we expect this, I guess, quote-unquote, Salvation Army to come across the Stock Connect and salvage really dip buying into these dips? And you know what we've seen so far, the answer to that is possibly yes. The 20-day average of the Stock Connect flows has now topped 10 billion Hong Kong dollars. That's the highest in 4 years. So we'll see how this interacts with the price on the way down. The open is next. This is Bloomberg.
Good morning and welcome back. You're watching The China Show. We are counting down to the open of markets, and that's a live shot for you from outside the Forbidden City in Beijing.
Yep, where it's a crisp 6 degrees going into, of course, what's certainly juxtaposed against possibly a hot week as far as news flow is concerned. We have the tariff conversation. We've had that response coming out of China. The Ministry of Commerce, CPPCC, of course, begins. You have the MPC briefing later today. And this time tomorrow will be that work report coming out of Chinese Premier Li Qiang. Welcome to the program, by the way. You're just in time here. 5 seconds to the opening bell. We're looking at shares of BYD. After the biggest cash call in nearly 4 years, they're over $5 billion US dollars. The open on the mainland, let's have a look at that, please. Thank you so much. We're down about 0.6 to 1% on the board itself, on the CSI 300. Shanghai crude is one we're focused in on quite closely, and as you can see, in case you don't see that, that's top row to the right. Down about 3% in the early goings as this decline in energy prices globally. You have West Texas, you have Brent, of course, pushing lower as well with OPEC Plus and them talking about output as well. Right, flip the page and have a look at Hong Kong. And within this, of course, BYD should be coming up on your screens. There we go, bottom row, second from the left. We're down about 7-8% on the stock. Alibaba's down about 3%. And Tencent is down 1.3%. So, yeah, you're getting money taken off the table. I'm watching volumes, turnover, and stock connect flows very closely today. There has been let me just do mental gymnastics here. There has been a positive correlation between the price decline and the amount of positive flows coming to the stock connect of late. So we'll see whether or not all this buying is able to salvage the session for us, which has been the case for the most part, not all. Hong Kong dollar is, the reason I bring up the Hong Kong dollar, on the stronger side of things. Liquidity is not an issue so far in Hong Kong. You have HIBOR rates remaining subdued. You have all this money, all this margin financing getting thrown at the IPO market. In fact, just on that very note, right? So Mishre, which debuted yesterday, is coming up on your screens. What does day 2 look like for that? In case you missed it, amidst all the big news out there, so there's that. The Leap Motor and FAW have actually signed this pact on developing new energy vehicles. And Brilliance China that's a special dividend, I believe, coming out of the company of about, I think it's $1 Hong Kong dollar. Thank you so much per share. Flip the page, and a couple of names that we are tracking onshore. You have let's have a look at this, please. Yeah, Shenzhen Zhongjin is speaking of cash call, that's also a share sale on the BYD broader story. And the other one is Gore-Tex, speaking of IPOs here, we understand, filed its IPO papers and maybe looking to be the next one to list here in Hong Kong, listing materials to the CSRC as far as a Hong Kong potential future listing in Hong Kong. And Gree Electric, I believe, is down to I think it's talking about one of its shareholders looking to increase their stake by the amount coming up on your screens very, very shortly, in the order of, I think, nearly $1 billion. Thank you so much. 2.1 billion renminbi. Okay. Yeah, we'll set that aside for now. Let's go back to the big story, of course, on stock-wise.
Yeah, the big story for us today, a big corporate story at least. Chinese electric vehicle maker BYD has raised $5.6 billion in Hong Kong's biggest share sale in nearly 4 years. The price was about 8% discount to Monday's close and sits in the lower end of the marketed price range. Our China correspondent, Min Lo, joins us from Beijing to break down the very latest details. I mean, let's first sort of dig into the BYD share sale. What's the sort of significance of this?
Yeah, it's a pretty big deal. I mean, it's the largest that we have seen since 2021, when Meituan raised about $10 billion in a combination of top-up placement and convertible bonds. And BYD selling about 130 million shares, 10% larger in size than what they had originally planned, although selling at the lower end of the marketed price range. And according to the terms of the deal that Bloomberg has seen, BYD plans to use the funds to invest more in R&D and accelerate its overseas expansion, because we know BYD has been looking to localize production to bypass some of these tariffs imposed by the EU. They had been looking at a plant in Hungary, in Turkey. They're also eyeing a third plant in Europe that could be announced in the next 1.5 years. But look, this is a company that has been performing really well, 160% increase in sales year over year, record delivery of overseas vehicles overseas. And in the last quarter, they also had beaten Tesla in terms of EV deliveries by about 20%. So on set to beat Tesla in revenue as well, and pretty strong demand with interest from sovereign wealth funds buying into this placement as well.
Yeah, Middle East strategic investors there, Min. And I guess since the money is now available, could this transaction be simply one of the first of more to come, perhaps?
Yeah, there is hope that maybe this would signal a rebound in share sale from Chinese companies, because it helps that the DeepSeek-driven rally has led to many companies really pouncing on this opportune moment to raise more funds. There have been several companies, including the robot maker, Ubitech, chip maker Black Sesame, an AI drug discovery company that has been raising funds in recent weeks. And according to Bloomberg calculations, Chinese companies has raised about $1 billion in placements globally so far this year, earlier, most of them in February. And certainly also helps that President Xi held that very high-profile meeting with the tech bosses, which could possibly signal an end to the rather volatile funding environment we have seen over the past few years. Also, the PBOC governor pledging to lower financing costs for companies, to diversify sources of funding for companies through bonds, loans, and shares. So possibly a change in that investment environment to a notably friendlier tone in China.
Min Lo in Beijing for us, our China correspondent, as part of our team on the ground. They're covering, of course, the NPC this week. Let's bring in Robin Xing, Chief China Economist at Morgan Stanley. Good morning, Robin. Nice to see you.
Morning.
So there's the NPC, there's the tariff story. Obviously, there's an overlap between the two. I want to ask you, let's start with the tariff story. So we're at 20% right now. The likelihood that this goes up is what for you? Because I would imagine that becomes increasingly disruptive to markets specifically.
First of all, the tariff in this round is much faster and broader than the one we had in 2018 to 2019. In 2018, it took about 7 months to see a 10% increase of U.S. tariffs on China. Now it took only 7 weeks. We had 20% tariff on China. And more, there is broader tariff on a lot of countries, Canada, Mexico, even other U.S. allies like Europe. This type of tariff threat is much broader than 2018 to 2019. So I think the bottom line is the impact on global corporate confidence could be even worse than 2018 to 2019, given the tariff is faster and broader. However, if you ask impact to China, we built in 25% cumulative tariff increase in our forecast for Chinese growth back in November last year after Trump won the election. Right now, the tariff increase 20% is more or less like front-loading our base case into first quarter of this year, but it's still within that 25% range we have provided in our modeling. So that's basically answering your question. For a lot of investors, the tariff risk on China is more or less in their model. However, what has not been in the model, what has surprised the people is the broader tariff on other countries. That's going to create a downside risk to global corporate confidence and FDI.
We spoke with Tsinghua Zidao Kui yesterday, and he's quite sanguine about the tariff risk. He said that Chinese economy is fully prepared for tariffs, which of course could be up to 60%. And I know you wrote last week about your expectation as a net increase in augmented fiscal deficit expected to rise 1.4%. So I want to ask, does 1.4% offset a 60% tariff? And if we want to offset a 60% tariff, what do we need if not?
I don't think the 1.4% increase in augmented deficit will be enough to resolve China's deflation problem. But it's a complex issue. I enjoyed so much from watching your China show because there are 3 things you covered so well in the last month or so. Tech, tariff, and all these economic policy targets in China. So tech, tariff, targets. You mentioned the fiscal deficit and the GDP targets from China. But meanwhile, what has changed is on the tech side. There were so many tech breakthrough news over the last 2 months with the rise of DeepSeek, little dragons from China on robotics, humanoids. I think that's a game changer for investor sentiment. That reminds global investors there is innovation capabilities here, and that also bring a revival of animal spirit. At least in the tech sector, we met with so many entrepreneurs. They feel excited after seeing now with much lower cost of AI, the AI adoption could be accelerated in China. And the Chinese tech firms are so good at adoption side, as you know. So I think there is a revival of animal spirit, and the meeting between the President Xi and the entrepreneurs 2 weeks ago, I see it as China's Stargate moment. They will probably encourage all these startup firms to go to Hong Kong for IPO, use that capital market ecosystem to grow. So I do think there is a revival of animal spirit, even without economic stimulus. However, China is still in these broader economic structural problems, housing downfall, deflation, and again, that 1.4% increase in augmented deficit, which, by the way, could be still investment-centric. The consumer portion of this package to be announced tomorrow will likely to be modest. So that's still not enough to resolve all these broader economic problems like deflation. But what has changed is the revival of animal spirit in the tech sector. So I do see some green shoots, despite current policy setup is still not enough to reflate.
Should we look to tomorrow for the offset, though? I mean, one of the comments coming through is either bullets are being saved for a worse day in the future, or policymakers are simply looking to see how the economy responds, and then they will deploy. And I'm wondering whether we've ratcheted up our expectations for tomorrow so much unnecessarily.
Well, I think you are right. The expectation on the MPC, on the government work report, has been more or less like much more reasonable than in previous years. I think what has changed is, number one, there has been a policy pivot since September. So China did something, tried to provide a floor. So this March MPC is seen as a continuation of that commitment. It's not something surprisingly new. Number two is on the tech side, all these breakthroughs helped to stabilize confidence. So people's focus gradually shifted from just on how much stimulus, how much handouts, to what can I do with the cheaper cost of AI? My firm can adopt this and try to do some business. So I do think the expectation in the market has been much more pragmatic and reasonable than in previous years. Having said that, since September pivot, we kept saying the current setup of the policy is still not sufficient. I don't think it's more about saving the bullets for potential tariff escalation. It's more due to Beijing's mindset of, they have a high debt problem. They don't want to do too much stimulus due to the concerns on debt. Meanwhile, they are still in the camp of if we do stimulus, we probably need to focus more on the supply side, investment, rather than consumer or social benefits. Last but not least, these moral hazard concerns. Will the central government step in to provide direct funding to restructure some of the local debt and the housing debt problem? We don't know yet. I think they are still debating internally. That debate has not been settled due to the moral hazard concern. That's the three problems constraining their policy reaction.
That's a really good point on that idea of some amount of policy inertia, or that things are still being worked out, and the point about the mindset in Beijing. You've written that you're expecting a limited effort when it comes to seeing economic rebalancing. And I want to ask, because the rhetoric has actually been quite strong on that from Xi and other policymakers. So what is actually preventing that economic rebalancing? And what are the consequences if we don't see that coming through the MPC, if we don't see that coming through other forums this year?
Well, I would say they tried. At least from October last year, they started to provide more cash for clunkers, this subsidy program for consumer goods. And this year, in the MPC, they are probably going to expand that program to cover not just the home appliance, but phones, some fast retailing goods. However, it's still goods. That showed it's an interesting mindset. If you are trying to encourage consumption on something, you try to focus on goods with a supply chain, goods like electronics or EV cars, because the supply chain can benefit. But we are arguing they can expand that effort to the scope of covering entertainment, services, travel, watching a movie, because all of these are creating the ecosystem for innovation eventually. People demand better image quality from movies, from games, that may help their GPU industry. So that's the ecosystem. But at this moment, at least in the upcoming MPC, I would say the focus of consumer trade-in program is still on these consumer goods, durable or some electronics, rather than overall entertainment or services. So that's one thing. The other one is, over the longer run, a more sustainable pathway for boosting consumption is social welfare reform, to provide benefits to that 250 million migrant workers, so they will reduce their precautionary saving once they had benefits like public housing, healthcare, and education. But that's very costly. We estimated the central government need to do fiscal transfer of up to $1 trillion in about 2 years. because migrant workers and farmers, they don't have their employers pay that pension contribution in last decade. So central government need to step in, providing that money to fill in the gap. And I think internally they are still debating, because that's a major shift of China's fiscal policy from an investment-centric fiscal policy, construction, capex, to social services. That debate has not been settled yet. Yeah.
Okay. Just a very brief one, Robin. Is it fair to say that Beijing tends to always be late with stimulus? And what does that tell us about decision-making process?
I would call this reactive nature of policy is due to multiple factors. I mentioned the concerns on debt, these moral hazard concerns, plus this investment-centric approach. However, eventually they will be evaluating the social dynamics. So if there is enough evidence from job market, from social incidents, from all these things they monitor with all these unemployment rates, I do think that feedback will trigger stronger, more decisive policy reaction. Like we witnessed back in September last year, it was partially triggered by the concerns on the local government functioning and how the job market has been struggling lately.
Yeah. Robin, fantastic, as always. And we look forward, of course, to hearing from you again and the team there and more of these updates coming through. And likely, don't put too much focus, of course, on this week. This is I think if you take a massive step back, right, once you're in the midst of a structural shift, you seldom realize that you are in the midst of one until, of course, it certainly passes. Anyway, we will still over-obsess over the work report tomorrow, plus, of course, other things that they may hint at there. Out of the NPC, these markets are coming off lows a little bit. We were down as much as 3% at one point on the Hang Seng, I believe, or the Hang Seng Tech. In any case, of course, still pressure across these equity markets. Plenty more ahead. This is the China Show.
Good morning. You're watching The China Show, and we are watching shares of TSMC after the world's top producer of AI chips pledged further investment into the U.S. CEO C.C. Wei joined President Trump at the White House for the announcement.
Today, Taiwan Semiconductor is announcing that they will be investing at least $100 billion in new capital in the United States over the next short period of time to build state-of-the-art semiconductor manufacturing facilities. I think mostly it's going to be in Arizona.
For more, our tech reporter Annabelle Jewellers joins us this morning. Belle, this spending adds to other plans that TSMC already have in the works. Just lay out what now the full picture looks like.
Yeah, well, this they made very clear during that press that their $65 billion has already been committed. This $100 billion is going to be in addition to that. So it's really this effort from the US, of course. We know that they want to be the dominant leader in AI. TSMC, it's the world's biggest producer of AI chips. Its main customers, they're also in the US, the likes of NVIDIA, Apple as well. But bringing more production to the US is a major investment because you're going to be now around that half a dozen plants. So around 3 for advanced wafer fabrication and the rest for advanced packaging.
This still needs to go through Taiwan, though.
Yes, and Taiwan just generally needs to improve any major outbound investment. But government officials have been discussing it just this morning, and essentially they're saying that this is a major milestone for TSMC. It also allows Taiwan to continue establishing that relationship as a key partner of the US, and this is something that Taiwan is really trying to prove its value to the Trump administration. But yes, something that did actually happen kind of quietly earlier this year is that TSMC essentially changed some of the rules around what kind of advanced packaging or advanced technology can go off the island, and 2-nanometer production can now be done outside of Taiwan. And so again, these plants in the US eventually we'll be able to do that.
Yeah. Where outside Taiwan is the question. Belle, thank you so much. Annabelle Jewellers there, of course, on the latest on TSMC and this massive investment into the United States. Right. Equity markets are coming off lows, although still down for the day. HS Tech down about 2.2, 21 minutes into the Tuesday session. All right, so we are I guess in many ways held hostage by this upcoming deadline on tariffs that are, as you can see, set to kick in 3 hours, 7 minutes and change right now. I think alongside the geopolitical story, chip stocks, we talked about TSMC and, of course, that big announcement that they had in the White House. Perhaps somewhat related to this is you have this sort of, I wouldn't say it's a side story, but related to the story. Singapore is investigating these potential fraud, in NVIDIA shipments. If you recall, a couple of weeks back, of course, there were some questions around how certain companies were able to access certain types of chips, and Singapore was one of the names that was brought up by that. In any case, you can read all about the story. It's also on the Bloomberg terminal for you, too. Right, robotic stocks. In Shenzhen-related robotic stocks, to be more specific here, this is really on the back of this announcement out of Shenzhen yesterday after the onshore market closed that they are planning to boost the humanoid robot industry. They put a number out as a target for 2027. So call it a 3-year plan if markets are reacting to that. And as we talked about here, we are still seeing some pressure across these equity markets. Asia's down over 1%. You have Taiwan and the Nikkei really to thank for that. And of course, the pullback we are seeing too here in Hong Kong. We were down as much as 3% at one point on the Hang Seng Tech Index, and as you can see now, that's just down just under 2%, 54.33. 1, 10, and 30-year yield on your screens in China, and dollar China too. At one point was above the 730 handle, and we've seen come off the lows there on the Chinese currency. In any case, plenty more ahead here. We're talking fixed income. We're talking Chinese economy with those guests on your screens coming up here on the second hour of the China Show.
Overall, it's still smaller than people anticipated. It's smaller than the year of 2018. So this time around, the Chinese economy is fully prepared. I do not think the tariff is a big issue. The way to deal with tariff is the same as deal with the other issues in Chinese economy, that is to boost domestic consumption. And on this issue, there's already tremendous discussions, and also a lot of policies will be implemented down the road.
And that was the former PBOC advisor, David Lidao Kui. We spoke with him, of course, this time yesterday on the China Show. And that specific comment was in response to why haven't we talked about tariffs as much? And as you probably just heard there, it's not a big deal, he says, as far as the Chinese economy is concerned. Now, all that being said, as far as markets go, certainly there is a tariff element to the risk premium that's back in markets today. We're down about 1.7%. On the Hang Seng Index, we're about 30 minutes into the session there. Tech, of course, leading these declines. In fact, just a look at some of the big decliners, too, there. So you have SMIC, which is the chip maker. You have China Unicom, one of the telcos. Geely Auto down about 9. And BYD, of course, is that cash call there of north of $5 billion. So you're really tapping that massive pickup in the stock price so far this year. Korea defense stocks, very much in focus too. So, we talk about Europe a lot and the melt up in yield, say in Germany, for example. That pocket of the equity market in Europe has done exceptionally well. I mean, the CAC index, I believe, if I'm not mistaken, hit a record yesterday. So this is actually almost the Asia-Pacific iteration of this go long on defensive equities. And this is really, as you can see, South Korea, the South Korea iteration of that as well. Right, very quickly, Asia ex-China. And we should be down about, there we go, just under 1%. S&P futures, though, have given up most of the gains. So it's looking quite rocky as well throughout the course of, I would say, just the next 48 hours or so, Rebecca.
Yeah, well, we're counting down to the implementation of these tariffs on China. That's expected to hit at 1 p.m. Essentially, Trump doubling the tariffs on China. And the timing is symbolic because it comes just as the country's top political advisory body is beginning its week-long gathering in Beijing. Let's go to Bloomberg's chief North Asia correspondent, Stephen Engel. He's joining us live from outside Beijing's Forbidden City. Steve, just lay out, what are we watching for this week?
Well, it was interesting to hear that soundbite from Li Daokui saying that, the National People's Congress is probably going to be really dealing with the structural issues in the Chinese economy, not necessarily responding directly to these tariff increases coming from the United States. So that's why the comments that we got earlier this morning, about an hour or so ago, was from the Ministry of Commerce. I don't expect the NPC, which begins tomorrow morning with the work report from Premier Li Qiang, nor the CPPCC, which is the big advisory body to the NPC, which kicks off its gathering in the Great Hall of the People later this afternoon. I don't expect either of those bodies to directly comment on the tariffs. It is at the back, if not creeping more towards the front of their minds, their collective minds. But again, the policy response that we're looking for at the NPC is how are they going to reach what is widely believed to be a consensus from economists growth target of around 5%, which is the same as last year. And they met that. And how are they going to do that? Well, they need to combat persistent deflation. Factory gate deflation has been persistent for more than 2 years right now. CPI inflation is tepid at best. So they need to essentially create some animal spirits. They need to get consumption going again. Another one of our guests yesterday, in addition to Li Daokui, was Kerr Gibbs, the former president of the American Chamber of Commerce, Shanghai. And he said some of these corporate giants in China are doing okay. Their biggest problem on the surface of things is finding available markets. If you take EVs, available markets are dwindling in the United States and in Europe. They have pockets around the world. But the biggest available market, obviously, for a lot of Chinese companies is China itself. So how are policymakers going to address that and make sure that the consumption trends pick up if their export markets are, dare I say, they're never going to be drying up, but they are shrinking a bit in the face of tariffs?
Yeah, well, Steve, speaking of, we're just hearing right now from the Canadians that the tariffs on their end, in terms of their retaliatory tariffs, will go into effect, what time is it now, in about 3 hours from now, and will remain until those U.S. levies are withdrawn. That's according to Justin Trudeau. The reason I bring that up, Steve, is we've heard from the Chinese as well, the Ministry of Commerce, although short of action, but they've said some things in response to this, Steve.
Yeah, that's right. So they didn't lay out exactly what they would do, but they're essentially saying that China will protect its own interests in the face of this increase of tariffs from 10% that was announced 3-4 weeks ago by the Trump administration now to 20%. And again, as we all know, on the campaign trail, Donald Trump threatened upwards of 60% tariffs on Chinese goods across the board. There was hope, perhaps among many market participants, that there was negotiation room for those tariffs to be implemented either slowly or actually be pared back. But the consensus wisdom is that unlike the Canadian government, unlike the Mexican government, the Chinese and U.S. governments, while talking back channel routes, have not necessarily begun negotiations yet. And that is also something that the Ministry of Commerce alluded to, that they believe that China and the United States need to get back into healthy levels of dialogue to resolve their differences. One of the other lines saying that they vowed certain countermeasures. The big question is what is left in the quiver, essentially, with those countermeasures, because 3-4 weeks ago, after those 10% tariffs were put into place, China was fairly muted in its response. I think they, like many of us, were kind of gauging just how far the Trump administration would go. Now we've seen them doubling of the tariffs, so we could see a bit more, strong countermeasures like targeting agricultural products. Keep in mind, the United States ships tons of soybeans to China, wheat, corn. So food products, agricultural products could be targeted by the Chinese. They don't want to target it too hard because China still needs those. But China, to their credit, since the last Trump administration, they've diversified their sources. They're getting more soybeans from places like Brazil and elsewhere. So we'll have to see what MOFCOM comes out with. That's the Ministry of Commerce, what they come out with their countermeasures. But soybeans could be in the crosshairs.
Yeah, Steve, you've been busy, and perhaps for our viewers who might think you're on holiday, they're about to end their gugong. You're not there for pleasure. The NPC, of course, is the big one this week, as you alluded to earlier. So what's on the agenda today there, Steve, in Beijing?
Yeah, well, it's the CPPCC, which is a mouthful on a very cold day, obviously, to pronounce. That's the Chinese People's Political Consultative Conference. It's a gathering of Communist Party officials, but also non-Communist Party officials representing a broad swath of the Chinese economy. They come to the Great Hall of People around 3 o'clock this afternoon. Lots of talk, little action. The action's going to be left to the work report from the Premier Li Choong tomorrow morning at 9 o'clock. Could last about an hour. Sometimes it's a little bit longer. Depends on how much he has to say. But likely he's going to set the GDP growth target, as I said earlier, of about 5%. But the big question is, how are they going to get that? How are they going to tackle persistent deflation? How are they going to get consumers here in China to feel confident to spend again? And that's one of the first steps is likely to lift the budget deficit target from 3% to upwards of 4%. Well, that would be the highest we've seen in 3 decades in China. So they need to pump trillions of yuan potentially into this economy, stimulate it, get the confidence going, and get out of this deflationary spiral. I do not, again, expect them to directly talk about tariffs, but they're going to talk about the challenging external environment.
External environment, Steve, fantastic. Thank you so much. Stephen Angle, a Chief North Asia correspondent there in Beijing for us. Joining us here on set to talk us through fixed income opportunities amidst, in so many words, what Steve pointed out there, the world is really in a messy place. Anitza is here, head of Asia Fixed Income Research at UBP. So amidst, there's a lot we don't know where the economy is going to go. Yields have gone opposite ways. You look at Europe, you look at what's happened in the U.S. What fixed income strategies have done well so far amidst this chaos?
Well, I think first we need to look at, where the U.S. Treasury yield would be, right, going forward. As a base case, where should we go for the opportunity? We still reckon the yield at the current level, like 10 years, 4.1% is pretty low. Basically, it's also because of, what's happening with the tariff implementation, people sort of like having some sort of weakness in the market. But we reckon the Treasury yield 10 years would go back up, later on, okay? At the moment, maybe, still at depressed level. We reckon because higher for longer definitely would be the theme, but we still reckon, given the fact that with some tariff implementation, there could be some impact on the market, which for the second half, there could still be rate cut, maybe 1 or 2 times. So at this point of time, I think what investors should look at would be carry. That is what they need to focus on. Secondly, what they need to focus on, because credit spread has been very tight, but we reckon could be resilient. It could widen out because Treasury yield has been very low, but then it still would not sort of widen substantially. So that's why we need to find something would be able to provide you with yield picked up. So we like bank AT1s, in particular those from European bank. We like corporate hybrid because those are the ones that will be able to provide you with some yield picked up. I think depending on the investment appetite, but at least, we've got the fact that we need to focus on carry. We need to manage duration. We prefer short dated. At the same time, yield picked up, would be something good for investor.
Corporate credit spreads have been pretty tight and pretty resilient, in fact. But over the last few sessions, we have seen, when we think about, for example, global credit spreads, they've been widening for, I think, the past 8-7 sessions. I mean, it does look like that tariff risk is maybe starting to crack that corporate credit story. What's your expectation from where we go from here?
Well, I think the recent reaction basically is in reaction to, the tariff implementation. I think market expected tariff, would come in 2025. Credit spread we still expect would be resilient. It could widen out. I mean, part of it is also because of sentiment. Part of it is also because low Treasury yield. People like to take profit. But given the fact that the all-in yield is still pretty, decent compared to like 2-3 years ago. And then when you talk about supply, issuance has been sort of like pretty manageable. At the same time, credit spread is a reflection of corporate earnings. We understand that in DM market, like US market, the corporate earnings still will be able to hold. Of course, you can argue that tariff could have some sort of impact, but we reckon that, credit spread could be resilient at this point.
How has the pickup recently, let me rephrase that, how has this story about defense spending picking up in Europe, and that's led to this semi-blowout in yields in Europe, how has that affected your call there in European AT1s, for example?
Yes,
if at all.
Yeah, there's a little bit impact, but if you think about it this way, bank AT1 from European bank is still giving you about 7% yield to call.
Okay.
It's still something that have pretty, much cushion.
Okay, that's a good spread.
People, exactly. So I just don't worry too much about it. I think it's still a good asset class to go into.
Okay. MPC is a big focus.
Yes.
Slightly less for credit, arguably.
Correct.
What are you expecting to see, and what are the potential impacts? I mean, we typically don't see a massive impact really on credit,
correct.
Right? But I want to also ask, what are the potential nasty surprises here?
I would say generally for MPC, credit spread is more matched with the environment, interest rate, rating. I agree with you, there shouldn't be big impact. But I would say if people are sort of feel comfortable with the policy, coming out from China MPC, then the China credit spread would continue to be sort of, well supported. There could be supply that we see from China SOE, China tech names, and, people would, start to look at that because of feeling more comfortable about the growth of China. I think, that's the main thing that could be taken from MPC.
Yeah. Would that then mean, because we're past peak pessimism, that it's perhaps time to look at opportunities, up the duration curve, down the quality ladder, for example?
I still would prefer stick with quality credit at this point, given the uncertainty ahead. Trump has been, doing different things different day, right? Talking about different things. So I would say quality would still be something we put priority on. If you talk about China, say for example China property, we still be cautious at this stage, even though contractor sales has picked up. But we think, it needs time really, to stabilize and restore investor confidence from that perspective. Yeah.
Is there anywhere moving down the credit curve where you do see a potential opportunity where you might be better rewarded as an investor, or really you're just sticking up IG, AT1s and so on?
Well, put it this way. Bank AT1 is already sort of going down, no particular credit curve, but going down on the subordination, right?
Yeah.
If you're just talking about credit itself, I would rather look at something that would have the upgrade potential. So that could be something we talk about, going down the credit curve, and that would boil down to our credit selection.
Okay.
So, a bottom-up approach, and have a look at what the credit fundamental, and select the one that would good potential to go up, and that could be something we talk about, go down the credit
Very
curve.
quickly, anything on Asia Financial AT1s then, on that note?
They are relatively tight, I would say.
Okay.
So that's why I always would prefer the European Bank AT1, and supply is also from European banks as well.
Okay, that potential upgrade. That's what we're all looking for, eh?
In life.
Thank you so much for joining us. Anitza, the head of fixed income research Asia at UBP. And still ahead on the China show, Natixis joining us to discuss China's top political meetings, which are set to begin just as President Trump doubles tariffs.
Yeah, but I have that closer look at what could be the biggest IPO in India this year, with Tata Group unit, let me rephrase that, seeks to raise as much as $2 billion. More on this bumper pipeline of offerings in India just ahead here on Shows. Welcome back. You're watching the China Show. We have some lines coming through here out of the U.S. Vice President. He's speaking in a Fox News interview. He's talking about, well, clearly there's certainly one topic in town. He's talking about how the door remains open for the Ukrainians, particularly President Zelenskiy. As long as Zelenskiy is talking peace, he's encouraging President Zelenskiy and President Putin to follow U.S. President Trump's pathway. So far, that's what we've heard so far from this interview that I believe is still ongoing there with the U.S. Vice President. He is speaking with Fox News. Now, just I guess a little bit of perhaps more context here. We have a Bloomberg scoop as well today, just talking about how the U.S. has paused all military aid to Ukraine. That story came out about just over, I would say, about 2 hours back. So do check that out, of course, on the Bloomberg terminal as far as there we go. On your terminals, on your screens. And so we can table that story for now, read all about this, of course. There we go.
Yeah, well, we'll certainly be following that closely. But shifting focus a little bit to another part of the world, one of our top stories, corporate stories particularly, Bloomberg has learned that India's Tata Capital is seeking a valuation of as much as $11 billion in what could be the country's biggest IPO this year. Bloomberg's Avril Hong joins us from Singapore. Tell us, what do we know about the deal so far?
Yeah, I mean, last week we saw how the board approved Tata Capital's plans for an IPO, sell 230 million shares with a tack-on rights offering for existing shareholders. And at the time, the reporting suggested that they were looking to raise as much as $1.7 billion. This would already have eclipsed the $1.5 billion that LG Electronics' local unit was reportedly looking to raise. Now, sources are telling Bloomberg that they're looking to raise $2 billion. They also say that, these are subject to considerations. Details could still change, but at these levels, they put it on track to becoming India's largest IPO this year. And for context, this is the financial services unit of Tata Group, whose businesses include a sprawling number of things, right? From table salts to Jaguars. And this unit provides shadow lending and manages about 1.5 trillion rupees worth of it. What's really interesting amid all this is how the Indian stock market has been slumping, but the IPO market in India just seems to continue defying the odds and that trend.
Will it continue to defy the odds and this trend and gravity? Let's put it that way as well. The IPO market. What's the outlook here, Avril?
It's looking very upbeat. I mean, we are already seeing in terms of the IPO so far this year, they are echoing the proceeds that we saw last year, which were already a record at $20 billion, second only to the US. We saw those record-breaking deals from the likes of Hyundai's local unit. And this year, we already started the year on the front foot. We're seeing it from Hexaware Technologies, upwards of $1 billion being raised. We talked to the securities regulators. They'll tell you that they're already processing IPO applications in the dozens, right? About 60 thereabouts. So it's really interesting to see, even though there's been a bit of a pullback in Indian stock markets because of these valuation risks or concerns, that the IPO market is looking quite healthy in India. And I think this latest potential listing would be a feather in the cap in the booming IPO market there.
Wow, 60 applications in the pipeline there. That's a Bloomberg reporter, Avril Hong, with the very latest. There's plenty more ahead. You are watching The China Show. Stay with us. This is Bloomberg. Good morning. You're watching The China Show. Here's some of the top stories that we are following this morning. Chinese solar panel giant Tongwei says industry agreements to curb overcapacity should take effect within months. Chairman Liu Hanyuan says industry and government are busy implementing output quotas for manufacturers. Liu also told us he's confident the solar industry won't be impacted by worsening U.S. trade relations.
After Trump paused the IRA funding signed by the Biden administration, the cost of America's photovoltaic manufacturing industries became significantly higher than that of China. Therefore, he had no choice but to raise import tariffs to give its own industries a chance to breathe and grow. However, the energy transition is unstoppable. Of course, President Trump can burn his coal, burn his oil, but we can rely on the sun's illumination to move forward. We're ahead of the game, so don't be afraid.
And Yomuri is reporting that 7&I is set to reject a proposed buyout by Alimentation Couche-Tard. Its report says a special committee reviewing the offer decided in favor of keeping the Japanese retail conglomerate independent, apparently out of antitrust concerns in the US. This comes after reports that board member Stephen Dacus is set to replace Ryuichi Isaka as CEO.
Right. Just look at markets right now. You know, the story that underpins this board of movers you're about to see on your screens. It's a lot of details here, but let me just summarize this. Singapore is looking into whether certain companies, you know, to say them, Dell and Supermicro servers actually shipped to Malaysia contained NVIDIA chips, barred from China, highlighting certainly the role there that middlemen have played perhaps here, potentially. I'm hedging a lot there. But yeah, you can check out the story. It's playing out across these markets today. In China itself, of course, the big one yesterday was Meishui, up 40+%. We're down about 3 right now. Brilliance China is a special dividend coming out of the company. And of course, on NEVs there, we just talked about that. Zhejiang Li and FAW together with this NEV partnership. We're going into the Japanese lunch break. More on that in a moment.
We should expect that additional 10% tariff to go into effect on China. And that's on top of the 10% tariff from just a few weeks ago. And that's on top of the 25% tariffs that were put in during the first term, as well as some Biden tariffs as well. So we're getting to an average tariff rate with China close to 40 or 50%. Americans are going to feel this in their pocketbook.
Investing in Asia, tariffs is inevitable. This is a region that is very export-oriented, but it's something that we've had to deal with through the noise and through the developments. So I'd say it really comes down to the bottoms-up stock picking, understanding which are the companies that are really the enablers that are irreplaceable, because with that comes the moats and the pricing power. And the good thing here is we've been through this before. We have precedents of what's happened in prior tariff situations.
In 2018, it took about 7 months to see a 10% increase of U.S. tariffs on China. Now it took only 7 weeks. We had 20% tariff on China. And more, there is broader tariff on a lot of countries, Canada, Mexico, even other U.S. allies like Europe. This type of tariff threat is much broader than 2018 to 2019.
And yeah, just some of our guests from today here talking about U.S. tariffs set to take effect on China, Canada, and Mexico, and certainly what you do with that information as far as this bottom-up stock picking perspective is concerned. As far as markets go, the reason I bring that up is we're now at about the midpoint of the session in terms of price. Asia Pacific just down about 0.7 of 1% across sector groups. As you can see, it's generally a risk-off session where you have real estate and healthcare, clearly defensives. Catching a decent bid right now. S&P future just coming off highs a little bit. We were up as much as 0.25%. Dollar is flat following, I forgot to mention this earlier on, ISM data overnight. ISM prices paid highest in about 2.5 years. So that's the undercurrent on the inflation story, Rebecca.
Yeah, and really we're just digesting, essentially. We knew that the implementation would be today when it comes to US tariffs, but markets, of course, still, digesting. We're seeing what's happening in currencies. We have an excellent guest to break all of that down with us. We'll bring in Alicia Garcia Herrero, Chief Asia Pacific Economist at Natixis. Let's start with the tariff question. You have said relatively recently that you think China might actually be a beneficiary in a world of Trump 2.0 tariffs. Just lay out your thesis and what that means for China's economy.
Well, first of all, we're already up 20%, so it's hard to say China will be a beneficiary, if only because I think many other Asian economies will be targeted. Mexico has already been targeted, same time as China. And that is only one of the very many bypasses, let's put it this way, of Chinese goods into the U.S. The biggest by far is Vietnam. Vietnam has a trade surplus of half the size of China, and that is literally 4 times more than Mexico. So that's next to come, in my view. And therefore, we'll see much more of that Asia-driven supply chain being hit. So there won't be many places to hide, I feel, compared to Trump 1.0. That's a big difference for Asia because, I think China had already got the handle of other places to go, which I think will be much harder down the road. And that is why, in a way, China is readier, because China will find other ways to find other markets to start, and secondly, to avoid any tariff, as they did. It will get harder. It will be different than Vietnam or Mexico, for that matter, but I think they are ready. And most importantly, and this is the MPC very clearly, we had Xi Jinping's latest, clearly domestic demand is going to be back. I think they get it now. There is no other way. A $1 trillion trade surplus is not going to happen again. So I think China has that room. If you're a small Asian economy, you don't have the room. So in that regard, I think China is a little bit more shielded than other economies in the world.
There's so much. You opened up so much doors there. Can I ask you then about? Let's start with the tariff front here. So it seems simplistically what the U.S. is doing is they're broadening out the borders to include markets where China has increased its trading mix, right? That's Mexico, Canada, Vietnam. So one part of my question is, do you think those countries, and I know Mexico, for example, is studying potential tariffs on laminated steel, for example, in China. We know Vietnam has done it on China. Should we expect those trade barriers to go up with those trading partners of China? That's one part, but yes, let's start with that.
Yeah, I mean, Mexico will come big on China. I don't think Mexico is such a big issue. It's like a fourth of Vietnam in terms of bypass. Right. So it's not huge because there's a lot of U.S. companies. So it's not really a only China-dominated market like Vietnam is. But they will, because Mexico has USMCA to negotiate, So it's not over. These 25% tariffs for Mexico, in my view, are temporary. The U.S. will come and say, if you really close down to China, we will renegotiate the deal, and the tariffs might be lifted at the same speed as they were imposed on Mexico. But, for some, there is no option, because China is basically their whole supply chain, or most of it. There, I don't think that Mexico's solution can apply. And that is true for many Asian economies. That's why I think we need to check for ASEAN, and especially Vietnam, but to some extent Malaysia, Thailand. I think it's going to be much harder for them to just say, okay, I impose tariffs on China. That's going to be very difficult.
And so that's on the supply chain front on ASEAN. Let me ask you then about ASEAN as an export market for China. Can those export markets be enough to offset, say, anything that goes away from others?
What we learned since China lifted COVID restrictions is that China's market was quite underwhelming. If you look at exports to China, there are some exceptions, critical raw materials and stuff like that for the green tech supply chain. But other than that, actually, the Chinese import market has been pretty weak. Now, the question is, will this new Xi Jinping's era, domestic demand, if it really happens, change that picture? And they can then, kind of mitigate the shock. Yeah. Hard to tell. We only have the headline now. Let's see if it's confirmed that China does import more from the rest of Asia. But for the time being, based on the data so far, the answer would be not really.
I just want to pick on a point you made there. This big question, if President Xi does make this pivot, right? It sounds like you think that the effort from Beijing is sincere to rebalance away from investment-heavy industry. How does that rebalancing actually happen? And how much of those efforts are we expecting to see this year? I'm not just thinking the MPC, but through the course of this year. Yeah. Why do I think it's more sincere? It's because the situation is difficult. I mean, a lot of growth in 2024 was really export-driven. Beyond that, we know, and we had actually studied at Natixis on the amount of capex in the manufacturing sector related to the export sector, mostly green tech, and it's a lot. So now that it's not only export, it's the capex for exports that needs to go somewhere. So I think that China does get it. They need to invest in something else. I mean, our proposal is look at green infra. The grid, you name it. So non-tradable, basically. Don't go on the tradable, go on the non-tradable. Go on sectors that will not affect you in terms of, U.S. protectionism. But, I think China gets it, but it has to be implemented. And
it's not going to happen tomorrow. We only know that it will do a little bit more fiscal because everybody knows the fiscal deficit will be increased to 4%. It's a signal. That's not the number, as we know. This is just, we have a lot of fiscal deficit in the local governments that is not recorded there. But it sounds like it's going to be more. However, it has to be much more. And why? Because the local governments, where we have figures for 2024, the revenue only increased 1.3%. It's nothing. I mean, their fiscal situation is getting worse even in 2024. So they need so much more help. And that's just to cover, you see, what the amount of growth that you had last year. So to keep 5% growth, which is what we're expecting, the fiscal deficit would have to be much higher than what they are announcing. Are they ready to do that? So that's why I say if. Because I would need to see even more, or at least the tone, than we are already hearing. Yeah.
Are they ready to do more?
I think that's the only way out now. I mean, last year they didn't know whether Trump would be Trump. Now they know, yeah? We just heard it, faster than ever, 20%. There you go. So I think if there is a chance that China does more, even in terms of reforms, we hear a lot on agriculture and the rural areas and, property of basically changing the property structure in rural areas. All of that is reforms. I think all of this is coming because of pressure from the U.S. So, in a way, silver lining for China.
What do trading partners do that seem to be on the fence, right? This pivot to the global south, for example, and we keep looking at how China diversifies its supply chain. What about for others? Do we see more capex, more FDI coming in to China for those that want to then be able to shield themselves from everything else that's going on?
Not yet. So if you look at FDI into China, it's still really underwhelming. 2024 was terrible. So will this change? Will, say, European companies say, you know what, we've invested huge amounts in the U.S., which is basically IRA-related trend. Will we go to China? According to the European Chamber survey, the answer is no, because their responses are basically, we're not increasing our investment. We're not thinking of increasing our investment. So, and I think the main reason is China's competition. China might look like a way to shield yourself, but if you have basically deflationary pressures, margins are low, a lot of competition, maybe that's not the market. And they might look for other markets, India, you name it, where the return on assets is higher. So I'm not sure there will be much more FDI. There may be more portfolio flows. Money's coming back, equities.
Yeah.
But that's short term. That's not really capex.
Well, that's a silver lining, I guess, if you want to internationalize your currency. We can get more on that next time, of course. Alicia Garcia Herrero there, Chief Asia-Pacific Economist at Natixis there. Now, that takes us into really the outlook for emerging Asia FX. Certainly, I think when you look at risk premia, let's put it that way, on the group, with the tariffs taking place, I don't know, to varying degrees of bad. Let's get a sense of what is actionable there. Let's bring in our FX reporter, Malavika Kaur, joining us out of Mumbai to talk us through this. And, why don't we get started with that, Malavika? What do the additional tariffs that we've known for a while mean for Asian currencies over the short term?
Volatility, there's just one word to it, because the specialty about Asian currencies at the moment is that they're highly correlated to the yuan. So if there are depreciatory pressures on the yuan, Asian currencies are also going to fall, especially those which are more trade reliant on China, which is what we've seen in the run up to today, the run up to the additional tariffs, that we've seen those depreciatory pressures come back on currencies, because at some point early in the year, markets had started really questioning if 60% tariffs are coming or not. There is a percentage of the population in the markets that still does not believe that 60% is coming. But the fact that we're seeing these 20% tariffs means that there is going to be more depreciatory pressure ahead for Asian FX.
Malavika, what does that mean for investors? Where are they going in this sort of context? And what's next for Asian currencies?
Yep, that's a good question because, where do you hide from the volatility? I think that's the question that's on everybody's minds right now. And they're truly looking for stories which are not correlated with, the U.S. tariffs or the trade war that's going to ensue. So they're looking for stories which have special domestic, factors that are going in their favor. So, for example, one investor pointed out the South Korean one to me, where he believes that, the political risk premium might be coming down, as political stability returns to the country. There's another one who's avoiding taking aggressive positions altogether in Asian FX, preferring to, go invest in Asian local currency bonds of countries like Indonesia, of countries like India, where, according to him, the risk-return profile is attractive. So that's what investors are doing. They are finding shelters from this volatility.
Okay, that's Bloomberg FX reporter Malavika Kormakol there. You're watching the China Show. There is plenty more ahead. Stay with us. This is Bloomberg.
Welcome back. You're watching the China Show. We had breaking news earlier today around our sourcing that the White House has ordered this pause to all military aid to Ukraine. Let's get the details on this Bloomberg story. Let's bring in John Harney, who joins us, of course, out of Washington, our Bloomberg editor, to talk us through what we know so far about this. John, go ahead.
So this represents yet another breach in the relationship between Ukraine and what had been its most steadfast ally, the United States. And this is yet and this represents another blowback, of course, from the now notorious Oval Office meeting of last Friday, in which ended in acrimony between Donald Trump and J.D. Vance, his vice president, and President Zelenskiy. It's unclear how extensive this pause is, but it's going to be quite significant because what our national security team reports is that Ukraine doesn't have, Ukraine's defense of its armaments, supplies, etc., as of now, will only hold out to probably the summer.
John, we've also now had comments coming from J.D. Vance that the door is still open to further negotiations. So, what signs are there, to the extent that we can possibly anticipate, that there may still be some kind of agreement, there may still be some kind of deal? Clearly, the U.S. is ratcheting up pressure on Ukraine. Absolutely. This is definitely putting the heat on President Zelenskiy after what happened last Friday. But the president himself, President Trump himself, today said that the minerals agreement, which was the ostensible the reason for President Zelenskyy's trip to the White House last week, but it could still be on. And as you say, Vice President Vance indicated that negotiated agreement, and that it involved Ukraine, although Ukraine might not be part of the actual talks, was still very much possible, but that more had to be done, and Ukraine had to give up some stuff, as he put it, and so did Russia. So does Russia. Okay. John Harney, burning the midnight oil there for us in Washington. Thank you for joining us. Now, shifting gear slightly, but still, in fact, with a geopolitical bent, the OPEC Plus alliance has announced an unexpected supply hike, which will be the first in a series of monthly increases to revive production that's been halted for more than 2 years. Let's bring in Bloomberg's Stephen Stevensky, in Singapore, to break down the very latest. Stephen, how significant is this?
This is a pretty big move. I think most people in the market were not expecting OPEC Plus to actually increase output. Now, They cut that output years ago to help balance the market and to help kind of increase prices. Now, Brent oil is trading, as you can see, around $71 per barrel, which is not where a lot of the OPEC members would want to be. Saudi Arabia is more comfortable in the $80, $90 level to balance their budget. Some even suggest that $100 would be their sort of target. But this sort of illustrates a situation, as reported by my colleagues in London and the Middle East, that this is somewhat to do with pressure from the Trump administration. Trump wants lower oil prices, and adding barrels to the market is a bearish move. And you're seeing that reaction yesterday and a continuation of it today. Trump has in the past put pressure on OPEC Plus to do what he wants, and at the same time Saudi Arabia, which is the de facto leader of OPEC, wants to also get investment from the U.S. and also boost investment in the U.S. likewise in that way as well. So all of this together sort of indicates an interesting geopolitical game. Trump benefits because if oil prices were to fall, while it doesn't help oil producers in the United States, it does help oil consumers, which is a lot of people, because a lot of people use gasoline to drive everywhere, and he wants those kinds of people to benefit. That's always been the thing that Trump has said, either on the campaign trail or in the White House. Look at the bills that you're paying. Look at what you're paying at the gasoline pump. That's what I did. And this is sort of a situation playing out in real time to illustrate that.
So, Stephen, let's follow that road down even further. What downside has opened up now as far as global oil prices are concerned?
We're facing an oversupply already before OPEC Plus was coming into the market to add barrels. Let me give you a little bit of context. The IEA said that we were facing a 450,000 barrel a day surplus for 2025. That's not because of OPEC adding supply. That's because of supply coming out of places like the United States, as well as Brazil and elsewhere. Now you add OPEC Plus, you've add more supply into the market, more of that frothiness, and it's going to be harder to see gains going back into the mid to high 70 level for Brent. There are some other weak factors you also have to take into account. With the trade war, also a Trump situation, with the trade war ramping up and the Trump administration potentially putting tariffs on a number of partners, that also reduces potentially economic activity, thus also essentially pushing down consumption of oil as well. That's another bearish factor. You also have China to look at. Chinese oil demand has been always sort of below the expectations of where the market was seeing them. There's a different story in China, one of which is, the growth outlook hasn't been as strong as analysts had expected last year, the year as well. You're also facing a big shift to EVs in China, and that's reducing gasoline demand.
Stephen Sapchinsky there on the latest in the oil story. And as he was pointing out, of course, a surplus that is likely to further get exacerbated with these latest price moves. Cities out with the note. Low 60s is what they're seeing here as far as Brent is concerned. Hang Seng Index coming off lows even further. Let's call it 0.5%, about 90 minutes into the session. Plenty more ahead. This is Bloomberg.
Good morning, you're watching The China Show. And Dave, there's a happy anniversary in the works due to you.
Well, not due to me. I'm
and the team.
And the team, yeah. So this time last year was the very first broadcast of The China Show. And it's not a coincidence, of course, that we're marking a big weekend on the China agenda this week with the NPC, and certainly the coverage that began this hopefully longer journey ahead on the China Show began, of course, with the coverage of the NPC. That's weekend. Since that point in time, certain things have played out, certain things haven't just yet. The unexpected tariff conversation we're having now, of course, certainly there was very little last year to indicate that we would be in this situation right now, that China would be facing 20%.
20% today, 1 p.m.
There we go. And, in case our viewers haven't marked their calendar just yet, we put a literal countdown clock in 2 hours and 6 minutes ahead of those tariffs taking place. But yeah, that's, I guess, a good way to look at currency markets and a live look at a White House. This is Bloomberg.